Welcome to another edition of Perspective. My name is Rob Pizzicato, founder of Mont Wealth, and today we are going to talk about the misunderstood benefit of growing your superannuation account. Now, before we do get started, the general advice disclaimer: anything I discuss today is general advice only. Anyone acting on this advice without written and agreed consent from a financial professional, a financial advisor, someone like myself, does so entirely at their own risk. My details are on the screen and they will be shared in the notes on the podcast as well. So hopefully you get plenty out of this conversation today. Now, I recently caught up with a client who said, hey, I really don't think I'm going to be able to achieve that retirement that I want. Living at the moment is quite expensive, inflation burden, teenage kids. I've got no surplus cash flow. It's a real concern. And I said, hey, hang on one sec. I think you can achieve it. Let's talk about how you can do that. So at the moment, if you're in your 40s or your early 50s, you're probably running on a financial treadmill, I call it. I've got 2 teenage kids, private school fees, cost of living pressures. Recently saw that private health insurance costs have gone up by 4% across the board from the 1st of April. Just also saw that wage growth is below inflation, so real income is shrinking. And for a lot of people out there, there's probably a lot of surplus cash flow that you can contribute to growing your superannuation or your non-superannuation assets. But I want to show you exactly how we can achieve the benefits of tax-free income in superannuation. Now, before we get into that part, let's also think about the changing economic landscape. Now, really think about how your superannuation is invested. Are you maximizing your returns? Do you understand risk and do you understand the reward? Obviously, a lot of market participants are focusing on the reward at the moment. There's a whole AI theme out there. We all want to be part of it. I get it. I believe it too. But at the same time, we're seeing a lot of volatility in that space. A lot of the hyperscalers are spending a lot of money on capital investment to ensure that they've got enough data centers to be able to cope up with the growth in AI and the demand for AI and the speed of AI. And then also there's concern around some of these software companies that AI will take and disrupt their market share and their moat. Obviously squeezing margins, we'll see how that plays out. So that's the first part, but also there's this whole inflation pressure that's overarching too. So if you look back from the 1980s to 2020 period, and I have spoken about this ad nauseum, but the old drivers really did generate a lot of the returns. We had baby boomers who were in their workforce. They had double incomes. They were able to take on more debt. We had globalization. We allowed China and others to manufacture a lot of our goods, which were lower cost. Technology started to evolve and it made us much more efficient. Cheap energy. No one really cared about fossil fuels and it was a cheaper source of energy. And that drove down prices of electricity. We were able to get cheap debt. As I said earlier, disinflation brought that down. Lower tax rates and lower risk-free rates. So this was all supportive of taking risk and generating returns. But what we've seen more recently and beyond 2020 is that inflation has poked its ugly head up again. Higher rates. I mean, obviously the RBA had really low rates during COVID and so did the world. But we're starting to see now that maybe there's no need to be cutting rates so aggressively. And as a result of that, the rate of return is going to be higher. So we're going to get lower growth and return, exactly what the RBA is indicating. We've got inflationary pressures and the economy is probably growing somewhere between 1% and 2% at best the next few years. What's driving that? Well, people are retiring. Obviously, there's a bit of a K-shaped recovery. Certain segments of the economy are growing faster than others. We've got larger debt. Again, going back to that double income, we saw house prices go from 3 times average salaries to now 8 to 9 times average salaries, which has forced us to take on more debt to buy that prime place of residence. We spoke earlier about globalization. That's now shifted to reshoring. Technology continues to evolve and innovate. We're seeing AI. It's going to be a game changer. There's no doubt about that. But how do we get positioned for that? Cheap energy, as I said, fossil fuels have now converted to renewables that we know are more expensive. And we're feeling the brunt of that in Australia specifically. Cheaper debt allowed us to take on more. But we're seeing structural drivers of inflation, which is pushing rates higher, but also Australia's inflation rates higher. So we're probably going to need higher rates for longer. Government deficits are higher than historically. As a result of that, higher rates are the only lever that the RBA has got to pull that can slow down economic growth and slow down the demand side while supply catches up. So putting all these things together, asset allocation needs to evolve and we really need to focus on the risk return to meet the objectives. I've also discussed ad nauseum that the Mont Wealth growth portfolio, strategic growth portfolio, is aiming to achieve 8% absolute returns through the investment cycle of 5 to 7 years. And the income portfolio is targeting the RBA cash rate plus 3%. Over the last 3 years, both of those portfolios have delivered in excess of those objectives. So we're happy with how portfolios are positioned going forward. So we talk about the multi-asset advantage, or the compounding comes from the growth assets that we have in our portfolio. And again, as I highlighted earlier, around AI and technology and where we're at the position at the moment, we saw in the past that the risk of having too much exposure and the valuations that they were trading on didn't warrant where they were trading. So we tilted our portfolios to global small caps, but also emerging markets. And we think they're expected to see additional growth in the near term. Also, real assets, they protect from inflation, i.e. global infrastructure, and also global property, and then also gold. Alternatives deliver non-correlated income. And especially here in Australia, we've got a exposure to private credit. And obviously the CBA results the other day highlighted that benign provisions in Australia for bad debts. So we're comfortable being there. And we've also got bonds for stability. Now, as I highlighted earlier, government deficits will remain elevated, which puts pressure on the long end of the curve. So you need to really allocate to bond managers that understand to invest in the belly or the short end of the curve. But at the same time, here in Australia, as rates remain higher, there's also opportunity to invest in floating rate bonds, which deliver a margin above the RBA cash rate. So corporate bonds are delivering somewhere between 6 and 7% income distribution. And overlaying all of that, we've got strategic positioning, whether we need to be overweight certain asset classes and underweight others, where we see the risk reward that is quite attractive. Now, we talk about the initial client conversation about not being able to achieve that comfortable and more than comfortable retirement. We're really targeting $150,000 of tax-free income in retirement per person, and I'll explain how we get there. In superannuation per annum, there's a concessional cap, which is $30,000 per annum. A lot of people probably listen to the podcast, exceed that, may have to pay a Division 293. We earn more than $250,000 a year, or you contribute more than $30,000 per annum, and any additional contributions are taxed at 15%. There's also the non-concessional cap of $120,000 per year. That is any monies that are after tax you can contribute into super, and there's also a bring forward of $360,000 once every 3 financial years. Now, for those that have got balances below $500,000, you are able to make a carry forward unused cap up to 5 years. There's also the downsizer contribution of $300,000 per spouse. The conditions to meet the downsizer contribution is you need to be over the age of 55, own the home for more than 10 years, and contribute into super within 90 days of settlement. At the moment, the transfer balance cap has just been increased to $2.1 million from July 2026. So that's a very important number, because what the transfer balance cap does as you move into retirement, the $2.1 million that you generate income from is tax-free for your retirement. The monies above $2.1 million are then taxed at 15% at accumulation rates. So here is the misunderstood benefit of superannuation and help you achieve your financial goals. It's the indexation of account-based pension. Now remember, $2.1 million is the transfer balance cap that you're entitled to use as you go into retirement, and you can withdraw or claim interest out of the $2.1 million at a tax-free rate to fund your lifestyle. Now, I always work off the rule of thumb of around 5% income distribution, given the Mont income portfolio. So 2.1 at 5%, you can generate about $105,000 of income off $2.1 million. Now, if you plan to retire in the FY27 year, your transfer balance cap is $2.1 million. Now, I'm 47 years old. I'm planning on retiring somewhere between 67 and 70. So if we fast forward and use the inflation rate of 2.5% in 20 years' time, that works out to be $3.3 million is roughly my account-based pension. Now, if we can't get a handle on inflation, it remains at 3%. The 3% rate is $3.6 million on a 2.1 transfer balance cap today. Looking at it that way, $3.3 million is the income that I can generate at a tax-free rate. Again, going back to that rule of thumb of 5%, 5% of $3 million is $150,000 I can generate as tax-free income in retirement. Now, if my wife and I both retire at the same time, and we've got twice as much as that, 6.6, suddenly as a household, we can draw down $300,000 tax-free from our account-based pensions. Now, the other benefit of indexation is the realised capital gains. Now, remember, the government is trying to pass through legislation right now about the $3 million balance. Any realised gains above that will be charged an additional 15%. Now, there's a particular formula that goes through that, so I won't get into the detail right here, right now. But again, a $3 million balance at the index rate of 2.5% in 20 years' time when I decide to retire is $4.795 million. At a 3% inflation rate in 20 years' time, that's 5.2. So suddenly the realised capital gains, the additional 15%, the Division 296, where I need to pay tax above the $3 million rates today, is somewhere between $4.8 and $5.2 million in 20 years' time. Again, showing you the benefits of building as much super balance as you possibly can. Now, again, there's another way of looking at this. And for those looking at the screen, as I highlighted earlier, I'll be targeting a $3.3 million super balance in my account-based pension. That gives me tax-free income to live my lifestyle. And at the same time, if I keep building my portfolio, the accumulation amount would be the account-based pension plus whatever the balance is, roughly works out to be about $4.7 million. So I'll have circa $1.4 million still sitting in accumulation if I'm aggressively working on my superannuation balance. Now, as I highlighted earlier, there are many ways of being able to do that. And part of that is the concessional caps that I can make of $30,000 a year, the non-concessional contributions of $120,000 a year, the downsizer contributions that I can make as well. So if I can aggressively do that in my 50s and my early 60s, there's no reason why I can't achieve that goal of superannuation. Now, for those that can see the screen at the moment, working off $150,000 on a $3.3 million balance, you can see that as my demands grow and I draw down that amount of money from my income, as it grows by 3% per annum, my balance also grows because it remains invested in the Mont income portfolio, assuming the RBA plus cash rate. So suddenly we're growing our balance depending on how much we're drawing down. If I wanted to draw down more, $180,000 a year, then suddenly the balance plateaus over time, but it doesn't deplete completely. And if I draw down less, it actually grows as well as we go because I'm not drawing down more than I need. So in summary, in your 40s and 50s, it is a financial treadmill. I understand it's quite difficult, but we need to maximize the returns in your superannuation and maximize your contributions if you can. Understand that changing economic landscape and your superannuation, as I said, make sure you've invested in the right strategies. Make sure it's working hard for you right here, right now. Understand the maximizing, how you can contribute to super, and obviously how indexation allows your balances and your tax-free income to grow. Remember, this is general advice only. Please seek financial advice. My name is Rob Pizzicchetta, founder of Mont, and my contact details are on the screen and also in the show notes. Thanks for listening. Looking forward to helping you in your future.